When it comes to investing in the stock market, you don't want all your eggs in one basket. So one way to diversify is to put your money into a fund. ETFs, which stand for exchange-traded funds, and mutual funds are both ways for you to own a bunch of different stocks all in one easy package. Buying one of these is cheaper than buying shares of all the individual stocks, and it's a convenient way to spread your money across hundreds or even thousands of stocks to reduce your investment risk. Say, for example, one of the stocks crashes. Owning a fund means you'll be okay because that stock is just one of many in your portfolio. ETFs can be bought and sold all day just like a regular stock, so its price will fluctuate. Mutual funds, on the other hand, are traded once a day after the market closes. The stocks in an ETF are chosen to follow a specific market index like the S&P 500, whereas the stocks in a mutual fund are chosen by professional money managers. And since these experts are investing your money for you to try to beat the market, mutual funds generally charge higher fees compared to ETFs.
Mutual funds could come with fees that could be a couple $1,000s. So if that's not something you're interested in doing, then maybe something like an ETF might be a bit more attractive for you.
You might also pay more taxes if you invest in a mutual fund.
When it comes to mutual fund investors, they typically are going to pay taxes for the turnover within the fund, and that's really because other parties are buying and selling shares directly, and that would affect the size of the fund. So that's something that could potentially be a con with mutual funds because they really come with taxes that create a lot of capital gains for clients, while ETFs don't.
There's also something called an index fund, which is a type of mutual fund that follows a stock market index like the S&P 500. It can only be traded once a day, just like other mutual funds. But because it follows an index, it doesn't need financial professionals to actively manage it.
If you're a first-time investor and maybe you feel like you can't stomach a lot of the volatility, you might be more attracted to, say, an index fund. So it really depends on the type of risk that a first-time investor is looking to get into.